Now we want to talk about the different types of stop orders. You know, there's only a handful of orders that every broker is going to have, and these are the types of orders that you can use to place your stops. The first type of order is what we call your basic stop order. It's just simply your everyday run-of-the-mill stop. This is your basic order. And if we were to really define it, what the basic stop order is it's really a trigger, like a contingency order. It says if this condition is met, then go place this trade. And upon meeting that condition, it's going to place an order for you. So in this case, it would say if the stock hits X price, whatever X price is, whatever your price is, if the stock hits this price, then go sell my stock and watch this at a market order. Underline that word in your notebook. Sell this stock at a market order. Market order is very important because your basic stop order triggers a market order to be sold, not a limit order. Consequently, there is the potential danger of something that we would call slippage in the trade. Slippage is, let's say, if you have a stop placed at 47.50, for example, and maybe by the time the order gets to the floor, the stock has been in a sell-off, and maybe they actually fill you at 47.35. That difference is what we call slippage, and a market order is subject to slippage. That's the bad part of the market order. Now, the good part of the market order is you're going to get filled relatively quickly, and that's the important thing. If you're in a panic situation, you probably want to get out of the trade as quickly as possible. So the market order has its pros and it has its cons, but you need to understand whenever you set a regular stop order, your basic stop is going to trigger a market order to sell your trade as soon as that price is hit at whatever price they can get it filled at a market order. The order is only going to be sent to the floor if the stop price is met. What does that mean? It means that this order is not sitting down there waiting to be filled, but rather it's only going to be sent to the floor upon that contingency, upon that criteria being met. Now, this is a myth that a lot of people don't understand about stops. A lot of people think that market makers are out there looking and saying, oh, Bob's over here, he's got a stop set down here at 40 bucks. I'm going to go run that stop, sell the positions, and then we'll continue moving the trade up. That's not true. In fact, the market makers cannot see those orders. All the market makers know are the live orders once they come to the floor. So those stop orders are actually sitting on your broker's computer waiting to be triggered, and once that contingency is met, then and only then is that stop order actually sent to the floor, and that's the only time that the market maker can actually see it. So that's the difference there, and I want you to understand that. That also takes some of that myth about, market makers just looking for your stops off the table. Yes, it's true, market makers do know that people have stops set below known support levels, for example, and they may run the price down to try to find some selling pressure if they're in a bullish market, but the market makers cannot see your stop, and you need to be aware of that. Finally, the last thing you need to know about a stop order, a basic stop, is it may or may not be filled at that price. Again, because it's a market order, it's going to be filled at the best price they can, but there's no guarantee of that price. Let's look at an example. If you came over and looked at this trade that we started off with Halliburton, let's say we entered the trade up here around $55 a share. Well, that was a decent trade entry, and there was reason to get in, but immediately the trade turned against us. If we had our stop in here, let's say we had set it at about $47.50, what would happen is when the stock hits $47.50, then a market order is sent to the floor to sell the stock at the market price. Again, what price that would be, it's going to be probably something below $47.50. It could be better, but the odds are it's going to be a little bit below that because of the slippage component of the trade naturally, and a market order does not guarantee a price. I want to show you in an order form right here how we actually set this trade up. This isn't an Options Express order form. All of your order forms are going to be relatively similar, but I want to show you this in a basic Options Express form. So first you put your symbol in here. So we got our ticker symbol of Halliburton. The action is going to be to sell. We've got our quantity of 100 shares. And then you come down here and you notice the type of the order. This is a stop on quote. And so here what we do is we put the stop price in, $47.50. And again, when the stock sells off and hits $47.50, at that time, this becomes a live market order and it goes to the floor to be filled. If you scroll on down through here, you can see the duration is set for a day. Again, if you set a day order, it's going to expire at the end of the day, so you would need to reset this tomorrow. If you set a good till cancel order, it will stay and it will only disappear once the trade has been canceled. And then finally, if you wanted to add in additional details in here, once you're done with that, you can press Preview Order and you can overview your particular trade. Let's look at the same type of a setup here in Options House. And the Options House trade setup, very similar ticket, just slightly different. We're going to put our ticker symbol in here. The action is to sell. The quantity is going to be our full position, which in our case was 100. And the price is a stop price. And then you put over here $47.50. That's the price of your stop. Now notice here, I want to just bring your attention to the point where it says stop. If we clicked on this drop-down menu, which I cannot do here in a slideshow, but if you're familiar with it, you'll know. You click on this drop-down menu and you've got the opportunity to click a market order, a limit order, a stop order, or stop limit. We've just selected a stop order here. Again, you got your duration choice. We can select a day order, or you can select a good till cancel by clicking on that drop-down menu. And then one of the things I like about the way Options House does it is you can see your order summary down here. Sell 100 Halliburton stock at the market price with a stop price of $47.50. So what is that telling us? It says if you hit the stop at $47.50, trigger a market order and go get rid of my stock. Now I want to talk about the stop limit order. The stop limit order is one way that we could combat that potential slippage component of the market order. The difference here is that it's going to trigger a limit order instead of a market. Your stop limit is basically the same as a stop order, your basic stop, but the difference is if the stock hits your price, then sell the stock at a limit order. Now what's a limit order? Remember, a limit order says sell my stock at this price or better. That's exactly what's going to happen with a stop limit order. If the stock hits the price, sell the stock at the limit order. The order is only going to be sent to the floor if the stop price is met, and when it is sent to the floor, the stock is only going to be sold at that limit price or better. So consequently, the limit order, it takes that slippage component out of the trade. So most people would say, well, I only want to set a stop with a limit order, right? Well, maybe. If you're in a drastic sell-off, maybe there's a big sell-off panic kind of situation happening and you want to get out of your trade quickly. Let's say it triggers your stop at maybe $47.50, but by the time the order gets to the floor, maybe the quote has dropped down to $47.35 by $47.40. Well, if you've got a limit order in there at $47.50, it's not going to get filled because remember the limit says at this price or better. And since we're in a panic, guess what do you think's happening? The stock continues to sell off. It's going down. It's going down. Now it's at 47. Now it's at 46.50. Now it's at 46. And you got a limit order way up here at 47.50. And you're looking at it and you're like, why did you skip over my stop? Well, it didn't skip your stop. Your order's sitting there. It just says sell at 47.50 or better. And because of that, you're limited. And yes, you can predict the trade a little bit better, but you cannot predict when you're going to get out of the trade. And because of that, in a panic, a stop limit order actually doesn't work very well at all. If you've ever heard of people saying my stop, stock gapped over my stop, well, the way that a stock can gap over a stop is it gaps over the price point, it triggers the trade, but it's a stop limit order. And then, of course, since it's way past that limit order, it can't fill it at that price or better. A limit order is not guaranteed to fill. It's only guaranteed to be filled at that price or better. So the risk that you run here is not getting out of the trade. And if you're in a massive situation where you're trying to protect your capital, getting out of the trade is kind of important. So you might want to reconsider using the stop limit. I'm not saying it's a bad order. It's just not always going to be the order that you really want to use. Let's look at an example here. If you come over to our Options Express order form, we've got the ticker symbol of Halliburton here. Our sell is the action. We're going to sell 100. And notice what happens here. This is a stop limit. And the reason it says on quote is because when the quote price for the stock hits $47.50, you're going to issue the limit order of $47.25. Now you notice what I did. I put the limit order a little bit lower than my stop trigger. Why would I do that? Well, if I put a limit order at $47.50, I'm probably going to be triggering on a downtick anyway. And so I'm immediately setting myself up to not get filled. If you put your stop limit a little bit below your stop price, there's a better chance that you're going to get filled. And you've at least been able to say, I really want this price or better. And you got a higher chance of getting that filled at that price. If we scoot over here to the next order form, you're going to notice I've done this in Options House as well. Same thing. We've got our Halliburton trade. We're going to sell the stock. 100 is the quantity. Now look at the price type. We've got a stop limit, and it puts right underneath it the stop price. So we filled this in. $47.50 is the stop price, and the limit order will be $47.25, duration for a day. If you want that to stay there forever, you would do a good till cancel. And then if you look at your order summary, it simply says sell 100 Halliburton stock at the limit price of $47.25 with a stop price of $47.50. What does that mean? It means if the stock comes down to $47.50, it's going to then trigger a limit order to go to the floor, and it's going to say sell my stock at $47.25 or better. That's a stop limit order.